For more, I'm joined by Simeon Gutman. He's Morgan Stanley's retail analyst. It's great to see you here, first of all. Welcome. So, let's kind of put it this way. Cataclysmically exposed to tariffs, or more like, hey, this could be a problem on the margin, and who are these companies potentially?
Could be a problem at the margin. It depends on a lot of things. 60%, who knows if that's the right number. High exposure to China, home furnishing companies, dollar stores, those are the general buckets. Last time this happened, it was probably a 1 to 2 quarter adjustment in demand. So there was a dip, and then it recovered. In a couple of these cases in home furnishings, a lot of the product, the same product that you see on marketplaces that you and I are comparing, it's all coming from the same region. So if you're shopping for it, you're not going to see a price that different unless a company decides to be more aggressive. If you're in the high end, it's a different story. But in a couple of these industries, especially dollar stores, toys, there's even some auto parts that are coming from the same region in China. You can't get around it. So the prices that you're going to see everywhere, there'll be an adjustment. There'll probably be a pullback in demand. The margin hits weren't so bad the last time.
How much did we actually increase tariffs last time?
It depends on the product category, but we went anywhere between 10 to about 20%, depending on the product category. And we had a couple of rounds of it, depending on the product category.
So it was significant. I mean, this would potentially be more, but, it's not like we haven't had some template. And that's why we were talking about this yesterday. But the fact that Skechers, I think it was so quickly able to say, we're going to source more of our product outside of China, tells you that sounds like some retailers have been preparing for this, at least as a possibility.
You hit the nail on the head. The apparel and footwear manufacturers have been moving production for years. Why? It's a generally easier process to move. It's a less heavy industry. Home furnishing, some of the toys within dollar stores, auto parts, bigger factories, bigger production, more difficult to move it down. So slowly but surely our companies are doing that, but we're not down there yet. We're like 20 to 30% still exposed.
And we've seen the dollar stores trade down since the president was elected. It's been a little bit different story. I mean, Home Depot and Laura Champagne yesterday said the company says that only 10% of its product directly comes from China. So I don't know if that's the best example or not. I mean, there's many other companies in that space, but they're not really the ones pricing this in, I don't think. They don't seem to be the ones having knee-jerk weakness.
No, and you picked home improvement. I'd also add auto parts. Those sectors have pricing power. If something breaks in your house, you have to get it fixed. You have 2 companies, large companies that control a good part of the market. That's where you're going to get the product. Same with auto parts. If you flip it back to the dollar stores, you have choices. There's more value. There's consumer shopping on different marketplaces. Walmart's taking a lot of share. So there's more options. Those 2 sectors, the consumer has a little bit less wiggle room of where to go.
Speaking of Walmart, I want to ask you about another couple of things there. But on the question of China, how exposed is that retailer? I thought I remembered them making a series of announcements over the years about, such and such percentage of our sales are made in America products.
As a company, Walmart is a grocer, and a lot of grocery in the supply chain is U.S. So about 80% of their sales are consumables, domestic grocery. Probably 10 to 15%, call it the rest of their general merch, is exposed. The percentage, we don't know exactly, but it's probably in that range.
Yeah.
They have scale. They have ability to negotiate, as do many companies. And at the margin, I think it's safe to assume that the largest companies will do among the best negotiating with their suppliers.
Plus throw in maybe some kind of, corporate tax. Certainly it doesn't look like the rate's going up. The shares are up 53%. They show no signs of concern, and that's this year. On the question of Costco, people keep asking for how much longer can it trade at 60 times, forward earnings, but it's been such a performer. You even think there could be yet another lever to pull if they're cracking down on membership. I don't know if we call it sharing, but if your daughter uses your Costco card.
That's right. Actually, she does use my Costco card, but not anymore. There is first a structural shift happening in retail. Big getting bigger, winner taking more. Walmart and Costco are in that category. That's fueling part of that Costco move year to date. The membership piece that we wrote about, they installed checkers. During COVID, I think people were using membership, especially when they installed self-checkout. And they've had success. When you scan your picture, you see your picture blow up on screen. They know if it's you or not. And they're going to say, hey, would you like to buy a membership? Because otherwise you're not shopping here today.
Wow.
And the value proposition is that good. It resonates that much, where the uptake during the trial period, we think, has been pretty good, up high single digits to low double digits.